What's going on, everybody? It's Blandon here from Leverage Addict Podcast. Welcome to another episode. And today I have Andrew sitting across me again, and we will be talking about 4 ways of leveraging into a business. Because Andrew, this is his favorite topic. He always like, no money down deals, no money down deals, So
Yeah, I mean, what excites me is building and growing businesses, and so many people think you either got to start from scratch or you have to buy a business, but you got to pay cash, and that's disheartening to me because there's so many other ways.
yeah.
And if you haven't read about them or learned about them from somebody or somewhere, then it can seem very frustrating and like impossible. But having bought some businesses no money down, and even with very creative terms, happy to share, and that's what I'm excited about. And I like teaching about it and talking about it because it helps me with my ideas as well.
Perfect. And it's great to also know that we have done these kind of deals for our clients. So we'll be going over some of the case studies. But first, before we dive into it, we're going to talk about the reason why you would consider buying or leveraging into a business. Well, for me, if you look at properties, because I always talk about properties, if you buy a property, perhaps if you're hitting that 10% cash flow mark or gross yield, it's already considered as a very high return. But if you're buying a typical SME in New Zealand, and Andrew thinks about much bigger deals, but I'm just talking about, your chipmunks or your, I guess, more high end cafe that can charge a premium, or potentially even like a laundromat. You're looking at anywhere between 20-25% return. Sometimes, if you get it on a slightly bigger discount, it might even be 33%. So, what I'm trying to say is essentially, if you buy a business for $450,000, you might see $140,000 in net profit. And it's very important to distinguish, though, when we talk about this return, it has to be based on the net profit after all of the operation costs. So sometimes a lot of the small business owner, they might sell a business, but they say, oh, it's 150K profit, but that is what they pay themselves. So that is not necessarily the kind of return you want to look for, because it's an operating expense, which is not actually profits.
Yeah, you really got to distinguish if you're looking to buy a business or be involved with a business. Are you looking to direct that business as an owner director? So strategically, you're giving a lot of input and you're overseeing the numbers and the financials, and maybe you're involved with hiring and firing, things like that. But day to day, you're not managing that business. So you're directing, not managing. On the alternatives, if you're buying a business where the manager director is leaving, then you are signing up to manage that business. Is a very, very different prospect. And as long as you know what you're in for from the beginning, you want to work out your return after your time and effort. So if you're only paying yourself, say, $60,000 as part of managing that business, but in reality, to replace yourself as the manager, it would be 120,000. It's a bit of a fool's game. So just understand the difference between managing and directing, and that will come down to what industry you choose and the size of the investment you're looking to make.
Definitely very important, because there have been many, many cases where a client might bring us a deal like, hey, this business is selling at 4x or 5x of the net profit, but the net profit is actually what it costs them if they were in that role. So, all right. So jumping into the first method of buying a business using leverage or using low to no money down, what do you have for us, Andrew?
Yeah, so I just want to strongly reinforce the reasons for buying a business. So we want to diversify our income source, even if we are in a strong industry or we've got a good job. It doesn't hurt to have diversity of income, and that might be diversity of location or industry, or diversification of how you spend your time. And then the second thing is so we can have more income to increase our borrowing power to keep making more investments. And you've got to deploy your cash into something, whether that's businesses or properties. We're trying to maximize and protect our our investments and our optionality. So, I've got business in chemicals industry and in the finance industry. There's very, very low correlation between those businesses. gives me good diversity of income and experiences, and it gives me ways to grow one industry or one business where the other is quiet, and vice versa. So having been getting into the chemicals industry again, having spent time in that game in the past, I have bought into quite a big business. Originally, it was $5 million business in terms of revenue, and I used some debt to buy into that business. And so my first kind of method of buying a business or buying into a business is using debt, obviously. Now, if there's a business broker involved, which I tend to avoid, they're going to want you to come and pay with cash and for the deal to be done quickly. But the reality is most people don't have that cash sitting around. So you have to think creatively about how to buy the business. And using debt is the common way to buy a business. And there's four kind of high level levels of debt or types of debt. You've got your bank debt, which you're going to the bank, you're putting your property up as security. And I would even under there, I would call bank/lender. That's personal loans. It's secured and unsecured loans. That's when you're taking out debt in your name and you're using a guarantee so that you can buy that business and the person that's selling it walks away with cash.
So just expanding on that, because that's a really important point, because a lot of the business deals that we do end up doing might be that kind of structure where someone has built enough equity in their property and they can go back to the bank to top up. Now, to make sure that they're not using all of the equity, we can actually structure the deal this way, which is a portion of it, perhaps 50% or 40%, is a top up on their property. And then the remaining portion, we would get a business loan through a bank like Heartland, where they would offer perhaps 50 to 60% of the business and they put a security over the business. And that way they're not using all of their equity in their property and they're able to keep building their portfolio. Now, if you just think of it this way, if you have a big portfolio already, if you bought a property management business that has 100K income, perhaps you can buy that for 500,000, but your borrowing capacity might increase by more than $1 million because of that new business income that you have acquired. So give us a second one, Andrew.
Yep. So we got on the debt side of things, we've got bank and private and professional lending companies, but we've also got vendor finance. So that means the person or people that are selling you the business, they can lend you some or all of the money to buy that business off them. And why would they do this? Maybe they like you. Maybe you're the only buyer. Maybe you're offering the most out of all of the options they've got. There's many reasons why somebody would sell you their business and lend you all the money to take it off their hands. They might have other business interests. They might have health issues. They might be moving country. They might have had a divorce. There's many reasons why a business owner in that time is looking to part ways with that business. And if you're the only option or the best option, they might just lend you the money. And they might lend you the money for a month for you to get the finance arranged. They might lend you the money for 10 years to get the to take over the business, and they might do it with a security or some general security agreement over the business. There's many different ways to think about it, but generally speaking, when I'm meeting a business owner and I'm talking about buying their business or buying into it, I'm starting with on the premise that they are going to lend me the money to buy it, and it's simply because hey, I'm leveraged in other areas. I'm looking after my cash, especially in the market that we've got. And if the business is as good as you say it is, me paying you back shouldn't be an issue. And so it really puts the onus back on them to not oversell the opportunity because they know if they're telling fibs, then you're not actually going to be able to pay them back. So it's a great way to build trust and to bring that into the negotiation and work on the same side of the table because essentially you're partnering with them. You're taking one burden away from them and then assuming a loan basically to pay them back.
Mm-hmm.
Now that's the second side of using debt. Now, the third side is asset finance. So if you're buying a business that has assets, fork hoists, stock, things on shelves, that a lender will lend against, you can take possession of the business and start financing some of the more tangible things to release cash, and that will help you either pay the business off at that time or capitalize the business so there's actually money in the account to run the business and grow the business. Now, a lot of businesses that I'm looking at, it's pretty common that older people own them. They got the mentality of not using much debt, and they've certainly got the mentality of taking money out of the business. They're at that stage of life where it's about dividends, it's about cash out. Whereas if you're younger or your business acumen is a stage where you are willing to grow a business, growth costs money. So if you have a business that's seriously underfunded, you can't grow the business. So even using asset finance or stock finance or just financing on something tangible, the bank will release money for you. You can then grow the profitability of that business without, taking money out in the short term. So that's what I've done with one of my chemicals businesses. Put in an overdraft of about 700,000, and that has allowed the business to buy triple the amount of stock as usual. So in a tight market, we've had stock and our competitors haven't, and we've won new clients as a result. So it's just thinking differently about using debt in the business. And then you should be able to, as a fourth channel with debt, use private finance. And private finance is, maybe it's your family or your friends or your colleagues or even potentially managers that are currently in the business. They're investing their cash in the business deal that you're trying to do off the back of the confidence they have in the deal that you're presenting. So how do you get a private investor involved? You have to show them the pros and cons of the deal, an investor prospectus or some spreadsheets and a slide deck, and why that they should put money into your deal. So you can go and say buy $1 million business. You might put 100,000 in, and you're asking a private investor to put 900,000 in, and you might be taking 10%, but plus an upside of the profit on the business that you're buying. Now that private investor that's putting the 900,000 in, they're going to want to see at least 15-20% return on their money, and they're going to want to see security, some form of security. So you're going to have to understand how the numbers work and get your spreadsheets ready. And that's where, if you're, for example, you're a lawyer and you have no hospitality experience, and you're saying that you want to buy a restaurant or a cafe, and you take that opportunity to a private investor, why should they do that deal? You have no knowledge of that industry. So you have to be able to answer those questions up front, that if you're going to tap the shoulder of father-in-law or mother-in-law and use their money, you have to be ready for those hard questions. And I think that you've got experience in that, Blandon.
So a good friend of mine, actually, Michael, he structured his gym this way, which is essentially he looked for gyms that had more than 25% return on cash.
Yeah.
So essentially what that means, if they buy a business for 400,000, they might have at least 100,000 net cash flow. And that means it's 25% return. So then what he wanted was to bring on some silent partners. Okay. And silent partners, meaning they don't need to do anything. So their return is not going to be 25%. Obviously, just like what Andrew is saying, they perhaps only need 15% return on their money. And because this deal is giving you 25%, so then Michael is able to perhaps sell some of those shares and give them 15% return. And obviously, you can see that really quickly. He would only have to put very little money in to own a much larger share in the business and get a much higher return on their own money. So this is a very much a real life example of what Andrew is talking about.
And he'll be paying himself a salary, as assuming the director's duties. He'll be doing a bit of the managing himself. He'll be using his spare time, so to speak, to manage those businesses. He'll be getting a return as an employee, but also as a shareholder. And that's kind of the way to go. You want to watch your egg basket closely, right?
Yeah. And I think the thing that I missed out in with this particular deal is that, well, actually Michael don't want to give up as much shares, so then he could actually fund 50% of the deal on leverage. So he would borrow debt against that business and then just raise around 45% cash, and he only have to put a very, very small portion of the cash in.
Yeah. So number 2 strategy is using an earnout. So what is an earnout? Now, most businesses, especially through a business broker, they're sold as a multiple of their EBITDA. Now, what is the EBITDA? Is basically the profit at the end of the financial year. And if you're buying through a business broker, that profit on the financials, the finalized financials, is not going to be the EBITDA that is presented to you from a business broker. Usually what a business broker is going to do is adjust it, and they're going to take out what they call the proprietor's income, and they're gonna make it look like it's the most profitable thing you've ever seen in your life. And then you've got to make sure you've got the actual financials that you're working with to see what the real unadjusted EBITDA is, because most things that they're adjusting out are actual real recurring costs. It might not be the same thing every year. One year it might be consultancy. The next year it might be like a payout from an ex-employee. The next year it might be a legal cost. The next year it might be an IT cost. And then there might be something that's maintenance that was a one-off cost. Now, these business owners and business brokers can get very creative adjusting EBITDA numbers. What's the point of all this? You want to get as close to the EBITDA number as possible, that's a real number, and understand the adjustments, because they can work both ways. You can start adjusting down where they want to adjust up. And an earnout, instead of paying based on historical performance, that's what most business owners and brokers want. Earnout is using future performance to help formulate the value of the business. So let's say a business been doing 100,000 profit relatively consistently for the last 5 years, and you pay 3x of that EBIT, then you would be expected to pay 300,000 for that business. But if you pay on an earnout, and let's say the business starts doing $80,000 a year, things happen. Maybe there was undisclosed issues, that there was no warranty in place with that vendor. Over the next 3 years, you only doing 80,000 instead of 100,000. You might readjust the price that you're paying down to 3x of that 80,000, and you're only paying 240 instead of 300. It's very, very important to get that right. And this is where you can start saying things to business owners like, hey, if the business doesn't perform anywhere near what you're saying it is going to perform, are you not confident? And you start having those conversations about why are you not confident that the business would perform at that level. Maybe there's some key clients that that they know are about to finish up contracts or switch to other providers. Maybe there's key staff members leaving. And that's why using an earnout protects everyone, and that you might have a earnout that if the business does go up, that the business owner that's leaving can actually share in that gain, because they've probably been working for a long time to build a positive momentum in the business, and they're worried about missing out. There's a lot of business owners that have been investing for 10, 20 years, and they're like, oh, next year's gonna be the year that all pays off. You can say, hey, look, you can share in that.
Sounds like me.
Yeah, there's a lot of business owners. They can share in the upside. So if you make an earnout that goes both ways, so the profit in this case, instead of being 100,000, goes up to say 130,000, they can benefit from that. So using an earnout provision, and if your lawyer doesn't know about this or understand it, you need a different lawyer, is adding in staff exit clauses. So with a lot of businesses, especially small businesses, there's one or two key staff members that are not shareholders that if they leave, your business that you're buying is in a lot of trouble. So you can add in clauses along with earnout that if those key members leave within 6 months or 12 months or 2 years, the price you pay for the business is adjusted down. So you've got a provision for it up front. Does that all make sense?
Nice. I think earnouts just the way you have explained it, would you say is a rarer version of negotiation? Because if they're earning out, I mean, they might as well keep the business if it's giving them like 20, like let's say if they're selling at 5x, they're getting 20% return anyway. So the earnout must be at least like double that if because now you're basically saying, hey, I'm going to pay you later
Well, most
and with your profits. So they would expect a much higher
and
higher
it might
payout.
be in combination, right? So in a property situation, 20% deposit, 80% loan, it might be that you're adding a component of earnout. And it might be that the owner has been doing 60 hours a week for 20 years in this business. What they want is to do 5 hours a week. And what you're able to do is you bring in energy, you're bringing your hours, you're bringing your oversight, and you're bringing some capital.
Perfect. So what you're explaining there is basically a earnout potentially might work better if there are some ownership or stake that potentially the seller is still holding back.
Yeah, I mean, you think in this scenario where, let's say, a guy set up a business 30 years ago, none of his kids are interested in being involved in that business. He's looking for somebody with energy and a little bit of money to come along and start taking his problems away from him. And that's what you can provide. And it doesn't matter if you have no money. What
Mhm.
you need to do is to have trust. And if you're working with a business broker on either side of the deal, they don't want the earnout. The only way that the business broker is going to allow for an earnout to happen is if their commission is paid before the earnout kicks in.
Yeah.
So you gotta understand that if you are working with business broker or real estate agent in any way, and you're trying to be creative with financing, obviously you're looking for win-win. But if you're looking for win-win-win, because there's now three parties involved, the agent's fee or the broker's fee needs to be taken into account,
Yeah.
and it might be that you pay from the business.
Yeah. So have you ever seen those YouTube videos of like these ads of the guys are like, why build a new business? Buy an existing one. That's one of the methods, right? To look for business owner that are probably phasing out. You know, perhaps they've done their years in the industry. They're very passionate about what they do, and they just don't want to just, either let the baby die or sell it for cheap. They want to have someone who's passionate about the business as well to come in, and they're more receptive to different terms.
And a lot of these people, they leave their estate planning far too late, and they get illness, or cancer, or they're on a limited time frame, and so they might be very strong negotiators and against any of these types of options. But what you want to do is, if they get themselves in a situation where it is too late for them to organize anything formal like this, the
Mhm.
sale process where somebody's going to come along and throw the heaps of cash at the family and everyone walks away, then creativity, like it does have to happen. and
Yeah.
and there's been plenty of instances where I've had businesses uh, with people that have had illness, and they needed a way to walk away, and often they've made their money, they've got a bunch of properties, they just need to have their obligation for their staff, their tax, their clients. They just want it taken care of. It's
Exactly.
not about the 1 million or 2 million cash or whatever. It's about having the legacy continue and the staff looked after.
So you just target the people that don't need money. That's a easier way to, negotiate terms.
What I do is I target long established businesses
Yeah.
that are quote unquote boring, because I know that younger people are generally not going to have either the capital or the interest to start in competition in those businesses.
Mhm.
And I'm looking for people that have left their planning too late. Maybe there was key managers they had that had left that they thought they might pass the business down to, and I'm providing my industry experience and connections and coming in and solving that problem for them.
Yeah. That's great. So what do we have on?
So number three method is using a deferral. So a deferral is awesome for cash flow. So let's say some business owner, the $1 million, that's what they want to sell their business for. Now you can agree to their price, but they need to agree to your terms. So you don't have $1 million, but You can see what the business is doing in terms of cash flow, profits, its ability to get funding. But there's usually like a 3 to 6 month period where cash flow is a bit tighter,
Mhm.
especially with shareholder changes. If you're having a major shareholder change in a business, they're going to draw their money out, and that business is going to need to be refunded, well, recapitalized. So you're either going to need bank finance, asset finance, or you're going to need to put in hard cash. So generally speaking, what I like to do is, if you can, work on an earnout, but it might not always get agreed to, especially if it's a really good business. Um, but if you can defer your payments, it allows you to operate that business from a strong position on day one. Because otherwise, what you get is, if you put your $1 million down on day one, you've got no money to fund and grow and manage that business. You can put yourself at huge risk when it comes to paying wages, buying supplies. Like, you don't have money to grow, and you might, or even to stabilize the business. And it might be 2 or 3 years before you're in a strong cash position again, and then you're growing the business. So what I like to say to the owner is, hey, I don't want to pay any money or very little money on the day this business changes hands. And you might provide them with like a 2, 3, 5 year payment plan. If you are going to do $1 million, for example, you might say, look, I'll pay you 250,000 a year each year over 4 years. Or what is even more attractive is, you might say, hey, look, I need 3 months before I make any meaningful payments. I'll pay you $1 million over 4 years, but the first year I'll only pay you 100,000. The second year 200,000, the third year 300,000, and I'll pay the balloon payment right at the end. And that what you're doing throughout the whole time is protecting your money, protecting your cash flow, so your business is always in a strong position. You're able to keep growing through acquisition of other businesses, through stock accumulation, through hiring talent. Basically, your pitch is, hey, I want this business that I'm buying to be in the strongest possible position, so that over this 4 year period, you are going to get your money. And you got to sell that vendor on the fact that if you give them too much money now up front, you won't be in a strong position, and they might not get all the money they're owed. And so they need to take some, that they need to be patient.
Yep.
And again, by deferring this and using a balloon at the end, they might want extra security. They might want to stay on as a director, where they've got oversight over the numbers and the strategic operation of the business, which is actually, in my mind, a positive. You can get them away from the operations of the business, where they will stifle innovation and growth, but strategically keep them involved. They've been running this business 20 years. They know things you don't know, and you can keep them on the board, essentially paying them with business, what paying them money. You might not even have to pay them any directors' fees or shareholder or employee fees. They'll just keep an interest, because obviously you owe them money. So if you combine debt with an earnout and a deferral, you're basically using those three methods to like reduce or remove the risk on you, like incinerating your money. Basically, know that a fool and his money is easily parted, right? And if you've got $1 million of equity or cash, and you're walking around trying to buy a business, you will find a lot of things. And it's tempting to say, oh, look, this business making 250,000, I get 25% return on my money. I'll put my $1 million down. But the thing is, shit happens. Managers leave, suppliers renege, clients don't pay. Like, it is a lot harder than you think. And so your 25% return on the year that you bought it, you might only get like 17% the next year. And so it's much better to have more creative terms and deals, because it aligns your interests.
Yep.
The day that that business owner gets all their money is probably the day you're never going to hear from them again. They're going to play golf. They're going to the holiday house. They're going to on cruises. Like, and good luck to them. So it's keeping them aligned with your interests for as long as possible.
Yep. I can see a deferral play similar in a property deal. You know, often developers might want to negotiate for longer terms for settlement, and they might put a very, very small portion up front say, for example, sometimes like 3%, and then they pay another 1%, every 2 months. And that can allow them to just stagger their cash flow, because they kind of need the cash up front to get the consents done. And the reason why they have it for 12 months or 18 months is because they want to make sure that they have all the building consent ready to go. They don't have to have any downtime before they start to build, and they have minimized their costs up front. So very similar methods are being deployed in properties as well.
That reminds me of an extremely important point, is about the buying entity. Is if you're signing contracts in your own name, it can come back to you no matter what, and over like a long time frame. So if you're buying businesses or properties, especially as an investor, now even Blandon will be testament to this.
Mate, just check out our episode 1 and you'll know the story.
You want to set up a company, and if you haven't done that before, it certainly seems more daunting than it really is. Company's office, it's like $15, and then it's like $150 to register a company. You want to be signing contracts in the name of those entities and getting legal and accounting advice as you go, so that if you ever walk away from something, it's a limited liability basically. And you need to be working with a lawyer that's comfortable explaining those things to you, and that you understand, like, why do developers pay small deposits and they buy in company names? It's so that if in a year's time, when they come to settle on that deal, if something has changed, there's no personal liability. They can walk away from their deposit, and they'll try and make those deposits as small as possible, and then it ends there. They can wind up that company. There's no personal liability or guarantee for them. So if you're dealing with a property developer, you're selling them something, go for the personal guarantee, and I assure you they'll walk away.
Yeah.
And when you're buying a business, if you can buy in another entity or a trust, that protects you. And if the vendor or the vendor's agent or broker is insisting on personal guarantee and all of this, you've got to be very careful that you understand the financial side of things and the risks, and that you're not putting up basically all of your security from family homes and investment properties. For the sake of buying $1 million business, you're putting up $5 million of equity and risking everything. It's not a smart decision.
Yeah. So tell us the last one, Andrew, and it's going to wrap up for today.
The last one is using the client book or clients of this business as a future payment method. So that might be through commissions or refinancing or through a merger with another business. But what a lot of businesses don't fairly or like easily understand is the value of their database and their clients, especially through the lens of refinancing or commissions, or how valuable those clients are to the competition. So if we buy, for example, in our mortgage industry, another advisor's book of business, and we refinance or cross sell, upsell that
Don't
client
tell
book,
them all our tricks. Come on.
then we can fairly work out how much that client base is worth, and it might be a lot more than the price that we're paying. Now, if we're trying to do a deal with another advisor where we're not paying them any money up front, then we might offer them a share of the future success. And it's the same with a lot of different industries, that if you merged the value of your client book into a competitor, the competitor is getting economies of scale. Yep. And you might have bought a business on 3x, and it's actually to the competitor worth 4 or 5 or 6x, because you're adding things together. So this is when you're getting
then when you put enough X's together, you get FTX. That's exactly how they that's exactly how they did their deal.
Yeah. So you've got to understand the value of the clients, and it's not just about future income; it's about future potential income, and that's where you might buy a business that is not the same as your current business or current industry, and it's a cross sell potential, and you know that you can lift the cross sell from say 5% as what it currently is to 33%, based on your inside knowledge. And what are you trying to do through any investment is you're trying to see what other people don't see. You're trying to create arbitrage for yourself, and through that arbitrage, your return on investment is a lot higher than the average in the market because you have that wisdom that other buyers don't have.
Yeah. I guess maybe would you say a simplified version would be like, hey, we've got maybe like a burger business and we only sell them burgers, and we're selling these clients at 4 times the profit, or selling this business as 4 times the profit. But we have McDonald's where we'll sell them the burger, the fries, the drink, the Happy Meals, the ice creams and whatnot, and all of these other things that we can sell them. To them, that is worth a lot more.
Well,
And
I'll give you an example that just popped into my head. So I go to the same cafe every morning, have my breakfast. Now, if that cafe was owned by the same people, or there was an arrangement that owns the pizza place next door, the pizza place could give vouchers, give discounts, make it super attractive for me to get pizzas from the same people, right? And if they did that, the marketing costs would be extremely small, and they wouldn't be taking business away from the cafe.
yeah,
They'll be getting business from the same people that can obviously afford it, and it would make so much sense. But they haven't figured that out yet. The pizza place and the cafe, they haven't talked to each other. They haven't done cross promotion. They've got the same client base. It's the same location. So if you owned both of them, you would be able to create synergy that would unlock profit.
yeah. I guess going back to that FTX scenario, is they had a lot of these businesses that has synergies, and when
Pretend
they
synergies.
when they slapped them together, the valuation just got bigger and bigger and bigger, and then they were able to leverage off that valuation.
Yeah.
But
You
that's
drag,
that's another day.
you're dragging me in the mud, man.
That's another day. We might cover that another day. But that sounds like we can go out there and buy some businesses today, Andrew.
That's what I'm doing.
Yeah. So with those 4 methods, we hope that you can utilize some of it to see actually how you can expand your portfolio, how you can generate more cash flow. And yeah, perhaps if you do have some ideas or you have a deal on the table that you want to discuss, then reach out. You can get in touch via email, support@mhu.co.nz, and one of our advisors can walk through your financing options on those deals. And until next time, we will talk again.